Hi, welcome to everyone to this new video. This is about chapter 12, the design of the tax system. This is a book of Gregory Mankiw, Principles of Economics, 7th edition. So first, we need to figure out that taxation is necessary for allowing government policies. So basically, because the government they basically need money in order to spend. So how do they receive this money? So they receive this money throughout taxes, basically. So here we already know from previous chapters that the tax modifies the market, and as a consequence, it affects suppliers and consumers depending on their elasticities. So we already know that the more inelastic you are, the more that you will be impacted by the tax. So the more inelastic curve is going to be the part of the market that need to pay more for this tax. So we already know that from chapter 11 that these taxes, as we said before, they affect, and we introduced one important term in economics, which is deadweight losses. These deadweight losses, remember that they are created because of the fact of the tax. So in this case, the market will not allocate the same resources as before. So consumers, they consume less, and producers, they receive less. So this quantity that is just like transferred from the previous condition where it was divided between consumers and producers, after the tax it will belong to no one. Okay, so at the end, when we already have this frame, we understand that everybody agrees that a tax system should be the smallest possible and the fairest. Okay, then the idea is to arrive to an equitable and efficient tax system. But this is a trade-off, as a lot of things in economics. The tax, if it's the most efficient one, likely it will not very equitable. And the same sense if we understand about the other part. So in order to have an overview, we're going to be focused mainly in United States, but actually, kind of the nations, they work kind of similar. So this first graph, we have the financial overview of the United States government. We have in the y-axis, we have the revenue as percentage of GDP. Remember, GDP is the gross domestic product. Basically, is the value of all services and goods final that they are produced in a determined period of time, usually yearly counted. So here we have like the percentage that is charged to this GDP during we have here in the axis we have during basically 20th century and the first decade of 21st century as well. So we have the 20th and 21st. So here we have divided United States. Basically, we have two kinds of revenue from the government total. So it's divided between the state and local taxes, and we have the other part, which is basically the federal one. So here we realize immediately that it was less than 10% the burden to people in general. Okay, it includes obviously like companies, but let's say the population in general here until this part. We immediately visualize here that the percentage arrived to around 21%, and there was an important drop. Basically, we would say that it's because the after Second World War, where naturally the national defense represented an important quantity of the revenue of the government because it was a war time. So for this reason, you see how it increased dramatically basically here. After that we see like here is almost contacts, yeah, it's like constant. Basically we have here like around 21-22%. So this is basically we have here like important drop decrease here, but naturally we'd say that it kept around this average. So here we have the total of the government. Now, in the next table, we have a really interesting tax revenue as a percentage of GDP of different nations around the world. We have the two, at least in this table, because to tell you the truth, I don't know if they are the countries that they have a highest burden to the people, but at least in our table they are. They are Denmark and Sweden. Sweden, they have like more than 45% Denmark and 45% Sweden. So they are really developed country with high standards of quality of life. So because actually when those kind of countries they receive more money naturally, the governments they are able to invest or to spend in more social programs like social security, unemployment, elderly people. So in this case we can understand that this is a plus for the government. Here it's located United States around 25%. And for example, we have here Mexico, which is really related. So for example, with my country, Colombia, which is not here. Maybe next edition it will. So the idea is like basically when you have like just a high total revenue as a percentage GDP, it doesn't mean that it's bad. It has to be like really well designated. So as I said before, this is a really important part to invest for the governments. Here we have, remember, the federal government, which is the blue part, which is the highest representative of the total government revenue. Actually, the federal government they collect 2/3 of the total taxes. Here we have the receipts of the federal government for one particular year. We are talking about 2011. Here, in order to understand this value, this is 2,520 billions, which you need to add 9 zeros, which is around here, and this is the quantity of dollars. It's really hard to measure them. Just when we divide it by the amount of per person in United States, we have roughly here the value, which is $8,077 per person, which is the income or the burden that is received for the federal government. And this part is divided in four like groups here. The most important one is the individual income taxes. It represents around 43% of the total income for the federal government. This is the individual income taxes. And here the second one is the social insure taxes. Basically, these taxes are earned, make it basically are used in some way to pay for social security and Medicare. And actually, This social security is an income support program designed primarily to maintain the living standards of the elderly. So it's a really huge part, which the destination is basically these kind of social programs. And here we have just to have a little bit more information that we are talking about. We are saying about that each April 15th, American families they have to fill out a tax form to determine how much income they have to pay. And actually, they have to declare all income sources, as for example wages from working, interest on saving, dividends from corporations, profits from any small business they have. So the taxable income is computed as a total income that the family receive, but naturally the amount based it reduces in the way that it depends on the number of dependents, so primarily children minus some deductible. So for example, you have mortgage, interest payments, state and local tax payment, and charitable giving. So because here we're talking about federal government, so it's important to figure out here that when you need to fill out this form, it's not just the money that you need to pay, but actually we need to take into consideration that naturally it takes time, and when it takes time it's important that each family they are going to have kind of a cost of opportunity of filling out this form. So for this reason even they need to hire someone to have some help for this form. And here, in order to understand a little bit, this is important to understand that in the United States they work as a marginal rate. What does it mean? Basically, it means that, for example, if your income it doesn't go up to this value 8,925, and actually all this is going to be taxable income at a rate with a rate of 10%. Once you surpass this value, the next value is going to be taxes with 15%. So for example, in this case, higher income families, natural, they pay a larger percentage of their income. But what is important to have here is, like, for example, imagine that a person there is like unipersonal or unifamiliar in some way. So there is just one person for this family, a single one, and the income during the year is $1 million. They need he still pays only 10% of the first this value of the first $8,925. When the income surpasses this, they're going to be taxed to different values. This one until this is going to be taxed with this percentage, and it increases when you get richer. So here we're going to talk a little bit about the different kind of taxes. So the first one is the payroll tax. Basically, it is a tax on the wages that a firm pay its workers. And there is another one which is the corporate taxes. It's important to take into account here that they are taxed twice. So in first instance, this is tax for the company, and second one, they are stakeholders. It means people that they are the owners of shares, and they need to pay for these dividends a tax. So for this reason we say that this tax is twice. But in order to compensate this fact or the double taxation in some way, so the dividends they are taxed at a lower percentage than the previous one. So other kind of taxes, there are the beverages, gasoline and alcohol beverages. Those are the another kind of taxes. So here we already have a look to the income. So which is the first part, the first sheet, the first part that we already have. And now we're going to figure out what's going on with the spending. Here, the spending mainly is represented in these four groups. First, the federal government, they need to pay for the income security, then health, the national defense, net interest, and other. You have here the value, and if you take into account the previous table that we had a look before, you have here that the spending is higher than the income, is what we call a budget and deficit. Okay, so United States, at least for 2011, but actually for several years, this is a budget deficit that the government faces. So here we have, for example, income security, which is the most important, is around 33% of total spending for the federal government. So this is kind of transfer payments. Basically, a transfer payment is like it doesn't not receive anything in exchange for a good of service. So just they provide. So as example, we have the social security income for elderly and disabled and employment. So these kind of transfer payments is nothing received instead of this transfer. And here we have the other part which represents the 25% of the total spending for the federal government. Those are the health programs. It is the Medicare, so basically the government's health plan for the elderly, and the other one, which is the Medicaid, is basically the federal health program for the poor people. So these two, they represent the health programs with 25% of the total one. And the other part that we have is the national defense, and the third one. So all them are salaries, so purchases of military equipment, guns, fighter jets, and warships. And actually, it increases in war period of time. Another part, which is represents the 9% with 325 billion of dollars, are the net interest. Those represent basically debt for borrowings of United States. So it means that, for example, the government, they need to pay for the borrowings that they have, because you already visualize that this is a government that spend more than the income. So if you have this hole, this fiscal hole, you need to finance in some way. So basically, as you do is throughout issuing debt. So when you issue debt, basically you acquire a compromise. Yes, basically you have like a compromise that you need to pay an interest to this person that they lent you money. And here in other, we have the federal court system, the space program, farm support program, housing credit programs, as well as salaries of members of Congress and the president. Those are included here in the 542 billion. Okay, so as we noticed, so we have a budget deficit. We have no, actually United States has a budget deficit, so because more spending than income. So imagine that we are in another situation when receipts exceed spending. So this is a situation that we call that the government is said to run a budget surplus. So here, as we said before, the government finances this deficit borrowing money from the public. Here we already talked about the federal government, so now we're going to have a look to the state and local governments. So they collect around the 40% of the total of taxes, and they collect around 2,064 billions. So it represents 6,600 15 per person. So here we realize here that the two largest, they are basically property and sales taxes, they are around 43%, and the sales taxes are levied as a percentage of the total amount spent at retail stores. This one, the sales taxes for the state and local governments. We have the property tax, which is the second one, levied as a percentage of the estimated value of land and structures, and are paid by property owners. So together, as we said before, they make more than 40% of total taxes for state and local governments. And here we have important fact that we need to focus a little bit is about the state and local incomes taxes are similar to federal income taxes. They are basically the same, but others they are kind of different. So for example, some states they charge you more for the salaries that you receive, another not much. Maybe some about alcohol they charge more than others. So it depends just like maybe the percentage for each state and local government. And we have here, for example, here uh, we have the other part, so we already have the income. Now we have here the spending. Again, it's higher than the income than receives. So in this case, we can understand here that not just federal government faces budget deficits, but also spending of state and local governments. Sorry, not spending, but state and local governments they face budget deficit as well. So here we have the highest spending, which is education. So it's important to differentiate here the local government pay for public schools, which educates most students from kindergarten through high school. State government contribute to the support of public universities. Here we have the second one, which this is the health program, which is like, for example, Medicaid. The third one, which is called public and order safety, which a percentage of the 13% of the total spending of state and local government. This is the public order and safety, which includes police, firefighters, courts, and prisons. Here we have the other one, which is called, we have the income security. Basically, for example, the building and maintenance of roads and highways and interest on state and local government debts. And we have the other ones which represent the 13%, actually like higher than the other ones. They are like 271 billions of dollars. Libraries, garbage and snow removal, and the maintenance of public parks and playgrounds. Here we are going to talk a little bit about taxes and efficiency. So remember that the government, the main objective is raise money, but policymakers need to think on efficiency and equity. This is important to find out the trade-off of that. So for example, if we have one tax that is really more efficient than another one, if it raises the amount of revenue at a smaller cost to taxpayers. So here, remember the cost of taxpayers is the cost of tax by itself and the deadweight losses, naturally. So here, we know the taxes they distort incentives, they entail deadweight losses. So we know that the deadweight loss is the reduction in economic well-being of taxpayers in excess of the amount of revenue raised by the government. Okay, because this intromission or this action of the government make that the allocation of the market will be totally different. The total well-being divided by consumers, producers, and government is less than it was before, divided just between producers and consumers. So it is the inefficiency that basically tax creates. People allocate resources according to the tax incentive rather than the true cost of benefits of the goods and services that they buy and sell. So this is the cost that we have for the deadweight loss. And here we're going to have just a little example depending of the burden of the tax. The higher is, the higher debt weight that we will face. So here we have a market. We have supply, demand, and we have here P1 and Q1, the equilibrium conditions of the market. And here we have the increase of the P2. Naturally is the price that is paid by consumers after the tax, and this P3 is the price that is received by suppliers after the tax. So just like this is going to be the total receipt of the tax. Here little triangle is going to be the the deadweight loss. On these two we have like different. This is a let's say low tax. This one is a medium one. So we realize here the deadweight loss is higher, and have a look here. Maybe the tax, the revenue for the government is almost the same, but the deadweight loss is pretty much really high. So this is what the government they need to considerate. Okay, so here we are going to talk about administrative burden. So remember, the administrative burden is part of the efficiency it creates. So remember, it's not just filling out form, but all the time imagine that you need to keep records of all your financial movements, your accounts. So it's really hard the time that you lose in these kind of facts. And even for that, there are a new like kind of market created, because even there are advisors. They help people to fill the form and actually define strategies to pay less, but taking into account that without being illegal. So basically they try to go through what is called in the law loopholes. So these loopholes, they are like kind of laws that you can go there, and maybe you can find a strategy in order to have a reduction for the tax that you need to pay yearly. So here now we need to differentiate between marginal tax rates versus average tax rates. So the average tax rate is basically the total expenses that you give to the government paid divided by total income. And instead we have that the marginal tax rate is the amount that taxes increase from an additional dollar of income. So let's put an example to be more clear. So imagine that we have the government taxes of 20% to the first $5,000, but once you surpass this floor, you will arrive to taxes of 50% after 50,000. So imagine that your income is 60,000. So if your income is 60,000, you will need to pay for the first $50,000 20%, which it brings 10,000. And for the other part we have 0.5, which is the 50% of the 10,000, which is 5,000. So at the end, the total expenses are the sum of these two, 15,000. So the average taxes are 15,000 divided 60,000. So we have 25%. So which is the marginal tax? The marginal tax would be this one. Once you pass this floor, you will need to pay for this 5,000, which is the value that you need to pay for this 10,000, because of the 50% on the total that is taxable. So you arrive here that your marginal tax is 50% compared with this average tax. So this marginal rate determines the deadweight loss. Why? Because naturally It is what distort in some way incentives. It determines if you really will work more for receiving more money, because you say, okay, if I work more than this 50,000, it will be charged to the 50%. So maybe I'll keep to this part, so I will not produce more. So this one is could be the deadweight loss for this new tax. There is another important part of taxes which are really interesting. They are called the lump sum taxes. They are basically a fixed monetary amount to everyone. So, for example, imagine that you need to pay $4,000. It doesn't matter if your income is 20,000 or 40,000. So at this time you will figure out that the average tax will be different to the people, because it will be for the first guy 20% and the other one 10%. But what is more important here is like the marginal tax is 0. So it means that it will not create a deadweight loss, because it doesn't distort your decisions. It doesn't matter if you work more or work less, you still need to pay the same amount. So for this reason it's called the lump sum tax. And here is the most efficient tax possible. But imagine if you need to pay 4,000 for one guy that just earns 10,000, are the same value for one guy that earns $1 million. So definitely it will not be the most equitable. So here, as we said before, the tax does not distort incentives. And actually, there is a minimum administrative burden on taxpayers as well, but it's not the most equitable. Okay, equity problem. So we have different theories in order to work on taxes and equity. The first one is the benefits principle. So in benefits principle, basically people should pay taxes based on the benefits they receive from government services. As an example, this is, for example, okay, let's have a look here. A person who gets the great benefit from a public good should pay more than a person who gets little benefit. So an example, the gasoline tax is used sometimes to pay maintenance roads. So you will not pay a tax if you don't use your car, but because you pay the gasoline, which includes a tax, you can infer that with this money, all people that they pay gasoline taxes, it's because they use the roads. So this money, it will be used just for that. So this is a benefits principle. So actually, like the police force as well, wealthy people, between quotation marks, they need to protect more material stuff than poor people. So poor people, they don't need the same amount of police force as wealthy people needs. Um, so in this case we have the other part, which is the ability to pay principle. So this is basically depending on the sacrifice to pay taxes. So this is divided between vertical and horizontal equity. The first one is vertical. So taxpayers with a great ability to pay should contribute a large amount. So basically it says that richer taxpayers should pay more than poor taxpayer. So this is clear, but the like something that is really hard to determine, and actually we don't have like a true answer, is about the scheme that policymaker needs to follow. We have three different schemes. We have the proportional tax, regressive, proportional, regressive, and progressive tax. The first proportional tax, it says, okay, of your income you will pay exactly 25%. And as you realize here, obviously richer people, they need to pay more. There is another one, regressive tax, which is this one. Actually, these guys, they need to pay more, but actually the distance between these two is less, okay, right? And this guy needs to pay more, but exactly remain the same like the middle one. And the progressive one is an increases. You have an increases, so this change is compensated by the reduction of this one is compensated by the increase of this guy. So definitely this is what it depends on consumer. It depends what really wants to do. It want to punish these guys with a higher, or maybe you need to compensate a little bit these guys, or maybe everybody kind of the same, so it's gonna be the aggressive one. So it depends of the policy maker, which is really hard and no answer to have the perfect scheme. And the other one is the horizontal equity. So taxpayers with similar abilities to pay should contribute the same amount. And this is important because imagine that there are two families, they earn the same quantity of money during the year, $100,000. So all this money is going to be taxable. But imagine that there is one member of the family that has a terminal disease and they need to pay every single month $20,000. Let's say $20,000 would be impossible to pay with this money, but it's going to be $2,000. So these $2,000, naturally, when you have the total income, you make some reduction for this money, so this is not taxable because it's not the same for the family and the other to pay this value. Here we have the tax incidence and tax equity. So as we saw in chapter 6, taxes altered supply and demand, as we said in the introduction. So it's important to have some scheme that may be in the normal life, we say. Okay, tax on for, or let's say better, on expensive clothing, and in this case 4 jackets. When we have that, we say, okay, let's put a tax higher, and this money, the people that they have money, they won't care, so they can pay more. But have a look to that, because imagine that there are several substitutes for these kind of goods. So these people, because of the incentives of the distort of the taxes, they will not buy more these jackets. So when they don't buy more these jackets, behind this in luxury industry, there are several employees that certainly they are not rich, they just work there, so they will be affected as well for this tax. So for this reason, it's important to take into account that. So just a conclusion, equity and efficiency are the two most important goals of the tax system. You need to find a middle point in order to have the best scheme possible. And actually, we need to say that it involves political philosophy as well as economics. And just my comment outside kind of this theoretical part from a Colombian, from Colombia, as a Colombian person, I would say that it doesn't matter the scheme or the point you use, because what I think is the most important thing is the trust. If people trust the government, they will not care to pay the taxes, because you say, okay, I pay my taxes, they are high, but my government spends that in a good roads, good health, good security, good social programs. Everybody will be happy. But when people try to uh, avoid paying taxes because they don't trust government, this is the hardest part. You cannot have like an important scheme. The important part is like government really use the money in a good way. It was the really most important stuff. Once we have this part, we can guarantee a great scheme. Not before. So just like a little comment for that. Thank you for watching my videos, and please see you next one. Bye bye.